Good morning, real estate mindset, and happy Monday, and happy Martin Luther King Day as well. The market's closed today, so we're still gonna do a great review, you guys, very in depth. We're gonna do a review, total review on interest rates, mortgage interest rates, and market interest rates. And then after that, guys, we'll go into a few videos that's gonna go into the expectation of certain people on what the Fed is gonna do next as far as cutting interest rates. So we'll also go into market expectations. I'll show you guys some charts on what's the concerns in the economy and what are people worried about. And then I'll go over my road trip, give you guys a simple update, and also go into Q&A as well at the end. And don't forget, guys, as I'm on the road, I'm going to try to do 2 videos where I'm taking the top 5 comments that you guys make on the live, similar to what Todd does. So hopefully I'll start doing these Mondays and Fridays. It's going to be hard being that I'm going to be on the road. And real quick, before I begin, special shout out to Tom or Scrog. Scrog put an offer in on a house and it did get accepted. I think he did that this weekend. So big shout out to you. He was very patient. He used the data and he's getting a good deal. I did a market analysis for him on that property, and the property that he's purchasing, again, join the Discord if you guys want to be a part of this, but the property he's purchasing is early 2021 prices. So we got early 2021 prices. He didn't have to go up against bidding wars and things of that nature. So big shout out to you, man. Thank you for being patient. Big shout out to everyone. Sheldon, Cindy, Ben, I see you guys. Vegas, House Hacker's been here. Johnny, I saw you as well. Sheldon, everything's going to be bookmarked as well. Good morning to everyone. So if you guys want to come back and really dig into this data, do that. Also, things are going to be linked, but let's get started right now, you guys, on the interest rate updates right now. So let's begin talking about the 10-year. So obviously you guys can see the 10-year is sitting under 4%. We want this to be at 4%. The higher this is, the higher that 10-year treasury note is, the more, basically the tighter things are in the market, the more distress and the more pressure that puts on the economy. So, it's up for the year. We started, I think, this year at like 3.90, I believe, but this has been going down over the last week or 2 weeks. Keep your eye on that. A lot of volatility. A lot of people still don't know what's going to happen. Eventually, it's going to go down when they start cutting interest rates. But right now, this is still elevated. We want it at 4. I think if it stays at 4 or near 3, close to 4, I think we're going to be okay. And I think really what we're going to see in the housing market, if people still buy, is more of an emotional thing. But again, as long as we stay right here, a little higher, I think we're going to be perfectly fine. So that is the 10-year, guys. Take a look at the shorter end right here. This is the 1 month. This is the liquidity zapper. Again, the market's closed today, but this is the liquidity zapper right here. So 1 month treasuries, this is what I'm investing my money in. I invest in 1 month treasury bills. I only do the 1 month so that my money is liquid, right? So I don't have to wait. And I buy blocks every week. So every week I'm buying a block of 1 month. So I have maturing T-bills every single week. Rates at 5.39, not a lot of change. They're really surprising. I mean, it stayed at 5.3, 5.4 pretty much this whole time. Very interesting to see that. Again, that's the liquidity zapper. But let me throw in now, you guys, the 2-year, because we've been watching the inversion of the 10-year and the 2-year as an economic warning sign of recession. So the 2-year, is going down as well. The 2-year, again, look at the 10-year. So the 10-year is under the 2-year. When this right here goes over this rate, then we have our reversion. Then the recession's like here or right around the corner normally. So you guys can see the difference between the 10-year at 3.94 and the difference between the 2-year. It's not a lot. It used to be a massive difference. Do you guys remember? I think we got over 100 basis points. So as far as the economic warning sign, this is absolutely insane. Oh, I didn't realize I put Vegas's comment up there. Sorry about that. Oh my gosh, Jeff is in the house. Jeff, good morning. W2H, good morning. Wolf, I gave you a shout out yesterday's video. Good morning, everyone. So here's the inversion. Here's pretty much the biggest case of an economic recession and turmoil. Who cares about all of the, meltdown in commercial real estate and all of the other obvious factors? This is going to be the biggest, bear case right here. It's the inversion of the 10 and the 2. And really what I want to point out, guys, is look at how quickly, this is a bull steepening. Look at how quickly it's been steepening. So we are only, I don't know if you guys knew this, we're only 18 basis points away from reversion or being uninverted, however you prefer to say that. But 18 basis points is That's really, really close, you guys. We are literally knocking on the door right now of recession. Comment below if you think you know what's going on behind the scenes to scare everyone. I personally think it's kind of like a no-brainer. It's commercial real estate. The turmoil in commercial real estate right now and the pressure that can put on the financing sector is overwhelming. If the financing and the banking sector goes down, everything goes down with it. That's why they bailed out the banks last year in March. But anyways, guys, only 18 basis points away. That is so close. Got that close around October, and then obviously got more inverted. But look at this. So it's not much longer. We don't have to wait much longer to really see what's going on. But still a lot of dust in the air, unfortunately. Let me show you guys what's going on with interest rates right now, mortgage interest rates, and I'm going to tell you guys how to shop for a loan properly. But mortgage interest rates are sitting at 6.69% on average. And I also wanted you guys to point out, I want to point out this. Look at VA and FHA. FHA has an interest rate on average about 70 basis points lower than conventional. A lot of people think conventional is the best way to go, and usually taking a conventional mortgage is the better loan for one reason alone, which is mortgage insurance. Okay, when you get an FHA loan, normally, unless you have 10% down, but normally it has mortgage insurance forever, 10% down, it has it for 11 years. With conventional mortgages, once you put 20% down, or if you have equity, 80% LTV, you can write into the lender to have the mortgage insurance removed. But understand as well, though, conventional mortgages are really, really heavy on credit. So you have to have good credit. If you get a conventional, usually it's better. But if you have credit, I would say under 700, you guys, I'm going to be honest with you, a lot of times, not all, but a lot of times getting an FHA mortgage, again, if you have lower credit, is cheaper than getting conventional. Remember, FHA lowered their mortgage insurance, which is called MIP, mortgage insurance premium, to 0.55. So put this in perspective, the mortgage insurance on FHA loans is like if you had a 780 credit score on a conventional. So the mortgage insurance, they lowered substantially. I think that was about 10 months ago, maybe a year ago. Anyways, guys, I wanted you to keep your eyes on that. We're going to go into our first video right now. And you guys, totally forgot to make our first timestamp. So I'm just going to do that real quick. And I'm going to make our other timestamp, which is going to be on our next video. But let me warn you guys real quick about this next video. It is from Bill Ackman. He's going to give us basically his opinion on what the Fed is going to do next with interest rates. So he's going to go into how many rate cuts. He's going to get fairly political. You guys know I refuse to get political. Okay, I respect you guys way too much, but he's going to get political. They're going to put a little bit of pressure on him to answer questions maybe he's not comfortable answering, but he's got some good points as it pertains to the market. So that's going to be our first video. And if you guys can let me know that the audio is okay, and I would certainly appreciate it. And I hope you guys enjoy this first video. Don't forget to comment below.
Briefly, though, about the markets before we get back to the Henry Kravis and plagiarism and free speech and anti-Semitism issues. You just saw that data come across the tape.
Yes.
Where are you in terms of the markets right now and what you think is happening or not happening?
So on the bond markets, I don't know if you remember, I tweeted that at 5%, I thought the 30-year had kind of gone far enough. We actually reversed our position and went, instead of being short the bond market, we went long the 5-year and the 1-year, again, through these sort of asymmetric instruments at that time. Rates have come in a lot. Right. We've kept that position on because we believe rates are going to come in further. I think the data point that came out this morning is sort of confirmatory.
You think there's 3 rate cuts in the offing now? 4? By the way, we had Larry Fink on in the 6 o'clock hour. He actually thought that we may not get those 3 rate cuts. Maybe it's 2.
Yeah, I think he's wrong. I think we have 3, or certainly, remember, 3 rate cuts is 75 basis points off of, call it 5 1/4, 5 1/2. That's not a significant move. 3 rate cuts would be like a 15% reduction in rates. Right now, we're, with inflation, cooling very meaningfully, the real cost of money is very high right now. So I think they're going to have to move early, and I think they're going to have to move.
So what does that mean?
It could certainly do more than 3 cuts.
What does that mean both to equities but to the larger economy as we look? Remember, we're in a presidential election year.
Yeah. So I think it's good for equities as long as they bring rates down fast enough to avoid a meaningful recession.
By the way, talking just for a moment, because I mentioned the presidential election, you have been quite active online about the election. At one point, you were supporting or at least talking about Vivek Ramaswamy, why Pierre is no longer in the game. But you've also talked, you've been a longtime Democrat, and you've been quite outspoken, it seems, against President Biden. And I think a lot of people are trying to understand your politics today, given sort of where things have moved here.
Sure. So one, I've always been a centrist, always believed in supporting who's ever best for the country, Republican, independent, Democrat. I think it's really important that Biden steps aside, says he's going to step down. I think he's, just on the age past his prime issue. I think a good part of the reason why we have what's going on in the world geopolitically is he's perceived as a weak president, and he will be even weaker in a year.
Does that mean that you would vote for former President Trump against President Biden right now?
I'll make that decision when I have the choice. But I would say what I'm hugely in favor of, and actually coming here right after this interview, is Dean Phillips. He's going to meet with the whole organization. Dean, a lot of people know who Dean Phillips is. He's a three-term congressman from Minnesota, considered one of the most bipartisan congressmen, super capable, entrepreneur, Belvedere vodka, that kind of high-end, what's it called, sorbet. But stick with me for a second. He's gone to 26% approval, or 26% of the vote poll in New Hampshire from nothing in a very short period of time. He's someone people need to take a look at. If Biden steps away, I'd love a world in which, imagine a world in which we have a capable, young, great, motivated, energetic person on the Democratic ticket, and we had something, something similar on the Republican ticket, and you went to the polls, and you weren't sure who to vote for because they were both outstanding candidates. I think Phillips could be very interesting on the Democratic side, and my hope for Vivek was he was going to be that person on the Republican side. I expect he might surprise people. People think he's out of the race, maybe, but I think Haley is someone. What's interesting, I think, about Haley, what I think is interesting about Phillips, is that I think Democrats and Republicans can support either of those two candidates.
Does that mean that you're anybody but Biden at this point? And the reason I ask is you've also talked, I think, about former President Trump being dangerous historically, and so now you sound open to voting for former President Trump.
My goal right now is to have good alternatives to Trump and Biden. That's my goal.
But if those are the choices,
I'll make my decision then based on the state of the world. But I can't imagine Biden. I just am stunned that he hasn't said he's stepping aside, and that is very, very. He will lose.
Fair to think that's a vote for Trump.
Trump will be our next president if Biden is the candidate, for sure. And I think, as Neil Ferguson says, he says if Biden is president. We're in a very, stick with me. His view is the U.S. is at grave risk with Biden staying as president geopolitically, but the Constitution's fine. With Trump as president, he'll keep us safe, but the Constitution's at risk. That's the choice.
Do you think your politics historically, which have leaned to the left, have been a mistake? And I ask because part of the whole political prism with which the arguments around anti-Semitism and DEI and freedom of speech on campus and in bigger institutions is now seen that way. Do you think you made a mistake?
I think that what the Democratic Party, what left means today, is not a party I want to be associated with.
Interesting.
And I think that's been a big. I was a Bill Clinton Democrat, and what the party has sort of morphed to is not something I want anything to do with.
All right, guys, we'll be done with that part of this video. Like I said, he got into pretty political stuff, but I mean, the election has started right now. Unfortunately, what I also want to, okay, so first of all, he believes there's going to be 3 rate cuts, 25 basis points each, 75 basis point total, I believe, this year. But he doesn't know who, it's very interesting because the House Smart's going to be a lot in politics and in the presidential election. So I don't know if you guys got the same feeling as me, but Bill Ackman seems like he's flip-flopping and he doesn't know what's going to happen next. Tell me if you guys think, and we're talking about extremely smart people. And generally, if they don't understand what's going to happen next, it's because there's smoke screens, right? Generally, it's going to fall apart. At least that's what I believe. So let me know what you guys think. But again, that was Bill Ackman. Thought that was very interesting to hear him kind of be flipping like that, not really knowing what's going to happen next. We're going to go into our liquidity now, you guys. Let's switch this up. So we're going to go a liquidity update, basically taking a look here. This is very, very intriguing stuff I'm about to go over with you. If you guys want to know what's going on with the money and what's going on in the economy, follow the money. And the first thing I'm going to start at is the reverse repo market. I've been saying over and over and over again that this right here, which you guys are looking at, is the smoke screen. This is all of the money left over from the excess printing. This is what is not only a smoke screen, but this is what is propping up the markets. The good news here, though, is the money is getting burned away. It is falling, you guys, at a rate that is literally, it's unheard of. Right now, we only have $600 billion left in here. This is the lowest it's been since June of 2021. So what was that? June 2021, that was what, 3.5 years, right? Or is that 2.5 years? 2.5 years. My point, guys, is the money's going away very, very quickly. In fact, it's almost gone. Remember in May, let's see here, about May, we were sitting at 2.2 trillion. So from May to now, we went from 2.2 trillion to $603 billion. Keep your eyes on this. This is, again, what I believe is the training wheels, why the economy hasn't even crashed yet. And then a lot of this money is also consumer money. So let's go over and let me show you guys now the Treasury General Account. Again, you guys, I want to show you where the money is at, like what's going on with the money. You follow the money, you can usually follow the story. So this is the U.S. Treasury General Account. The interesting thing is this is actually, it's been going up over the last 3 weeks. It's gone down recently, and understand that the Treasury can sell treasuries. So if they need money, they will sell treasuries, 10-year, 2-year, 1, whatever, right? And when they sell treasuries, more than likely that's going to put pressure on rates to go up. Again, like right here. So they can sell like this right here. They can sell a 10-year, right? They can sell this 2-year right here. And if they do that, depending on the demand, this will elevate interest rates. So if tomorrow they sell 2 years, that will go up depending on, again, you guys, the demand. So if you're wondering what's going on with the Treasury, they have $747 billion. So between the reverse repo and Treasury, that's about $1.3 trillion of liquidity, but that's coming off of roughly 2.7 trillion. So again, roughly we're going from 2.7 to about 1.3. So a lot has been happening. Still a lot of money though in the economy. That's why I'm worried about these rate cuts being too small in the front end of spring home buying season, like I've been warning us about the whole time. Not that I don't think that the market's going to collapse. I just think that if more people keep buying, it's going to continue to prop it up and push the can down the road for a short amount of time left. Now, let me show you guys the assets held outright as far as mortgage-backed securities. Now, remember, you guys, the Fed can manipulate interest rates in multiple ways, and I'm talking about mortgage rates. So even though when they're changing the federal funds rate, that doesn't directly impact mortgage rates. Because look at mortgage rates went down a full percentage, but the 10-year stayed the same. The federal funds rate stayed the same. Everything stayed the same, and yet that went down because, again, 10-year Treasury. But if the Federal Reserve wants to sell or buy mortgage-backed securities, they can, again, put pressure on mortgage rates to go up or to go down. And that's part of the reason why we had such low interest rates for so long, because the lenders lend, say, at 2%. But lenders don't want to lend at 2% because they don't make no money at 2%. So the lenders lend at 2%, and then they sell that to the Fed or the Fannie Mae and Freddie Mac, and then they keep lending again. And they take a quick profit up front and then keep the 2%, 2%, 2%. But again, what I'm saying is they couldn't have done that the way they did it without them buying mortgage-backed securities. So the good thing is this has been going down. Has it been going down enough? No. Absolutely not, but it has been going down. So that means they are not purchasing mortgage-backed securities. That's great. Take a look at the M2 money supply. This is also very intriguing. We may have hit a bottom in the M2. You guys can see this is the 1-year chart right here. Again, this is the money supply in the US. So this is total money supply, right? You guys can see for the first time since the Great Depression, the money supply has been going down. Again, since the first time since the Great Depression, I believe in 1930, I believe was the last time that this has happened. So money supply going down, pretty much flatlined right here, slight down, and we may have hit a bottom right here because look at over the past few weeks, about a month and a half, I'd say, the money supply has been going up, and maybe that's why the stock of the S&P, because usually this tracks S&P, I've been told. I'm not a stock market guru, but it's very interesting, again, to continue to watch the money. When the money goes away, things fall apart. And speaking of money and liquidity, take a look at this, guys. Here's the consumer credit card debt. And I wanted to talk to you guys about this to kind of just plug some holes in what you're hearing, in YouTube land or on the news. So right now, consumer debt is at 1 trillion. and this is just credit card debt, literally the worst debt you can have. Now, the interesting thing is many people, this is based on billed amounts. Okay, so the 1.02 trillion is based on what bills on a credit card statement. Okay, so a lot of people after the credit card bills, they pay it off and they collect their points. Except for me, I pay it before it bills just because I like to stay ahead. And whatever bills is what's reported on the credit bureau. So that's also why I do it. So I want credit bureaus to see I always have zero balances on my credit cards. But based on data that I reviewed, I believe it was either from I think it was the CFPB or the FHFA, and I could tell you guys right now that I think it's around 54% of people are not paying down and off their credit card. So most people are keeping a balance on their credit card and rolling it over to next month. And that's exactly what you don't want to do. If you're going to take advantage of these cashback buying incentives, you have to pay down your credit card. You have to, you guys, because if you don't, you're going to be drowning in, maniac type finance charges. And I also want to tell you guys like what I'm using real quick before we get into our second video. That's going to go over people that think that there's going to be 200 basis point rate cuts. But I'm using for my like regular purchasing, I'm using a Wells Fargo, what's called Wells Fargo Active Cash, because that card gives me, this is so crazy, 2% cash back. Literally on my purchase, it gives me 2%. It's the best one I could find. And then for like my online purchasing, which is Amazon, our family uses Amazon a lot. We have, obviously we have 3 children here, so we have to go through that stuff a lot. It's like every day there's a package in front of our door. I feel like I have an addiction, like, oh my God, what's that package? But I get 5% back. So I have an Amazon card, gives me 5% back. And I have my Wells Fargo Active Cash that gives me 2% back. And remember, I have zero balances on my credit cards when they bill. So I'm taking advantage of the high rates. I think, a lot of people should do that. So again, that's how I'm spending my money, getting $200-$300 back, sometimes $400 back a month. And then I've taken my liquidity and my down payment for a house, and I've bought 1 month treasury bills. So I'm also getting $200-$300 back there. And basically, guys, I'm doing nothing, right? I'm doing nothing. It's just a way that, something my family and I are doing to try to get ahead of how unaffordable things are right now. And every time I hear how strong the economy is and how great the consumer is, I roll my eyes because to me, it doesn't feel great at all. It feels extremely toxic. So we're going to go into our next video right now, you guys. This is a little bit longer, some pretty good perspective here. These people think that we are going to have a 200 basis point rate cuts, and they also think that we're going to go into recession. I'm interested to know how you guys feel at the end of this. And let's get started right now. I hope you guys enjoy.
Michelle Girard, she is the head of U.S. at NatWest Markets, and covering the equity angle is Joanne Feeney. She's a partner and portfolio manager at Advisors Capital Management. Michelle, what gives? This is pretty shocking to think that, okay, maybe rate hikes are back on the table. This is just based on what the market activity has been recently.
Well, there has been an easing in financial conditions, particularly as you move through year end, and the market got very euphoric about the possibility that the peak in rates was in and started to anticipate rate cuts. I think probably the market's a little ahead of itself. The Fed may be trying to, pump the brakes a bit in terms of market exuberance. But some of the data that we've seen of late may be doing that. The data isn't as weak as maybe the market had thought. The bottom line, though, is we do think that the Fed is done raising interest rates. And it really gets back to the fact that not only is the economy slowing, but more importantly, inflation is moving lower. And we'll get this week's number we can talk about, but I think the bigger story is how dramatically those year-over-year figures are going to start to decline as we get into the spring, given comparisons to very high readings in early 2023.
So you think rate cuts are coming when?
We think they start in May. So right now the market is betting mostly on a March start. The market is looking for a series as many as 625 basis point cuts. We don't think the Fed starts till May, but when they do start, we think they go more aggressively with 50 basis point rate cuts at a pop. And we think the Fed will end up cutting rates by over 200 basis points in 2024. Again, we have inflation year over year down under 2% by middle of the year.
Michelle, we spoke with Roger Ferguson, the former vice chair at the Federal Reserve on Friday. And yes, I would call him Roger. We spoke with him on Friday after the jobs report that came out. And he said that if the Fed were to start cutting rates, let's say in the first half of the year, it would require that the economy took a significant downturn, leg down, that it was under some serious pressure. Is that what you think happens in order to get the rate cuts in May?
Yeah, I guess I should have said, not only do we see this dramatic decline in inflation, we do also, we're forecasting a recession. We think that by the middle of the year, we'll be seeing negative GDP. We're already seeing weakening. We think the consumer in particular is going to continue to come under pressure. And so it's that combination of inflation being back at or below target and the economy in a mild recession that we think leads to these aggressive rate cuts.
Joanne, we have seen the markets trade up pretty significantly on the idea that the Fed will start cutting rates sooner. If they do it because there's a recession that's taking place, does that still make sense from the market's reaction?
Our view is a little bit different. Yeah, our view is a little different. We don't think it's likely, at least in the data currently and projected, for the Fed to cut rates anytime soon. In fact, we think the market is far too optimistic about that. And moreover, the economy remains very strong. The consumer real incomes are rising. Real spending has been going up. The labor market remains very tight. So there's a lot of wage pressure, which is why we think inflation is probably a little bit slower to come down than some others think. Nor do we see a recession on the horizon, given the strength of the underlying manufacturing and services sectors in the U.S. So we think it's a little bit early to call a rate cut. And we do think, as you point out, Becky, that potentially could pressure equities. Valuations are taking into account those rate cuts, but we think that earnings, and more importantly, guidance, can be sufficiently strong to offset any reversal in those interest rate expectations.
So you think the market is maybe misjudging things from what's going to happen with the economy and with rates, but you think it's okay to stay long at these levels because you think companies will just perform pretty well anyway?
Well, the reason why we think the market is a little bit ahead of itself with those rate cuts is because the economy is so strong, is because the labor market remains tight. What does that tell us? It tells us that firms are still out there trying to hire, and they're doing it because they continue to see strong demand. And so in that environment, that sets up public companies pretty well to continue to grow sales and profits. We do think it's going to be something on the risk side to keep an eye on, which are a lot of those tail risks, whether they're geopolitical, China, Taiwan, China, the US. We heard over the weekend some more concerns about China restricting trade. So not that there aren't risks out there, but fundamentally the US economy is still pretty strong in such a way that's keeping pressure on wages and potentially on inflation. So rate cuts are a little farther out.
Yeah, there are some people who are still looking at the markets right now and say that this is the year for all of the non-growth stocks to kind of catch up with the growth stocks. You think growth stocks are still actually a pretty good place to be?
Yeah, we have, depending on the strategy, we think there are roles for both in portfolios. Last year, a lot of the value and dividend-paying stocks really got hurt because money markets drew away so much out of the equity markets, particularly in those modest dividend payers. So we think there's a chance now that rates are going to at least flatten for some of that money to come back, especially with the anticipation that eventually rates will fall. Similarly, as you point out, value stocks really did not do well as growth stocks surged last year, but that was really AI-driven, AI-focused, very narrow market. This year, we do see lots of attractive opportunities in value and a broader recovery in areas of the market that suffered declines because of some weakness in spending associated with those higher interest rates we saw last year.
Joanne, you got any thoughts on Boeing? I don't know if it's stock you own or just watching the huge declines this morning.
Yeah, we have actually avoided Boeing. We've been concerned about their problems with the MAX and how long it would take for them to iron those out. We were a little bit enthusiastic about the recovery they were seeing in shipments to China. Obviously, now we're much less enthusiastic about taking another look at Boeing. Quality problems, I think, are going to make investors really concerned for quite some time about that particular name. We prefer, Raytheon, which also had an issue with the powdered metal contamination, but it's one that they really got ahead of. They revealed the big hit they were going to take to free cash flow. So we like Raytheon as a play in that market, also for its defensive role in a portfolio against things like geopolitical risks.
Michelle, very quickly, CPI this week, what are you looking for?
Like consensus, 0.2 overall, 0.2 on the core. The core will tick down to 3.9 from 4, so that'll be a good improvement from where we ended last year at 5.7. As I said, those declines are going to get even more dramatic, and that's where I think the Fed will find themselves questioning the need to have rates at 5.5%. when inflation is so close to target. As Jay Powell has said himself, they're not going to wait until inflation is at target. It takes too long for monetary policy to act. To be having the foot this strongly on the brake when inflation, as I said, in coming months is going to make a lot of progress toward target. I think that's going to get that'll be the main impetus driving the Fed's decisions here.
Alrighty, y'all heard it. Let me know if you agree. You guys are. I've seen you guys in the comment section so mean to that lady. Why are you guys so mean to that lady? Actually, both ladies. But if you think about it, guys, I mean, how crazy it is, like how split. And it's mostly on the bullish side and I believe because they're getting paid to it, but how crazy it is, like how split these very smart, very intelligent people with probably $250,000 in school loans with, like a doctor's degree in economics. How crazy is it that they're like, some of them are like the exact opposite from each other. And when that happens and everyone's not on the same page, usually it's because there's like really bad things that are going on in the background because the bears have a case to be made. We're not just saying this stuff, right? But anyways, guys, I think you're going to like this next thing. We're going to go into some data charts right now. And I love this myself. I thought you guys would love it. Let me make my next timestamp here. So this is from Visual Capitalist. If you guys want to, this is already linked in my description if you guys want to go back and take a look at this. But this is cool, guys, because this is going to tell us what the biggest risks are right now, or rather like the black swan, right? Like what's going to be the next black swan? What's the market and likelihood? And this is a quote from Charles Schwab that I really like. Too bad they don't follow it themselves. History shows us that the biggest risks in a typical year aren't usually from out of left field. Rather, they are often hiding in plain sight. Isn't that, in my eyes, that's exactly what's going on right now. Like these problems are like right in front of us. Like, and especially if you've been watching my channel, I linked the data. You guys can find this out for yourself. But like, why the heck does so many people, and I'm talking about consumers, not economists, keep their head in the sand? That's so dangerous. Maybe they're okay. Maybe they're rich. Maybe they're rich and they don't care what happens next. That's fine. I'm not rich. I'm a normal person. I care what happens next because I need a house that's affordable. I will not overextend myself to purchase a house. But take a look at this. So this is very interesting. On the bottom here, from left to right is the highest likelihood. So the further to the right, the more likely this event is going to happen. Now on the left axis here, you can see the higher this is, the more impact. So devastating impacts. And what you'll see here is the very first thing here, guys. This has the highest probability of happening and also has the second highest impact on the economy. And guess what that is? Okay, so the biggest warning here is the debt cycle and aggressive monetary policy, that lag that Jerome Powell has been talking about kicks in. Remember, Jerome Powell's like, oh, the economy still hasn't felt the full force of the quantitative tightening. It lags, it lags, it lags. Well, the biggest warning sign right now that investors are looking at is the fact that that lag is coming due. The bill is coming due. So that is the code red. Okay, the lag is coming through the system, which we've been waiting for what now? How long have we been waiting? I've been doing this a little less than 2 years. My 2-year anniversary, I think, is March 1st or the end of February. But anyways, guys, that's the most likely outcome. But look at the second most likely thing here. This is very interesting as well. Sudden geopolitical fracturing from elections or conflicts. So this is saying the world is in turmoil right now. The impact won't be nearly as bad as what our economy, going into a recession would be. But it's likely that there's going to be some fracturing. Now, this is interesting. The third most likely thing is the Chinese property market crash. But I'm like thinking, like, how is that not 100% likely? Because that's happening right now. That's happening right now. So, but it's interesting that that's the third, most likelihood thing. Now, here's the interesting thing, you guys. Then we come to commercial real estate collapse. This is what I've been circling a lot. I think, obviously, this is going to be a result of the aggressive monetary policy, right? So the aggressive monetary policy is kind of like very broad. So they've taken a lot of, it's very broad. But again, fourth likeliest thing is the commercial real estate collapse. I'm thinking that's 100% likely. I mean, it's happening right now. It's just the banks are not doing nothing about it. So very, very interesting. Then we have natural, energy prices, corporate, strengths. North Korea. It's funny that North Korea missile tests hits an allied country. Do y'all see that? That's on this, right? So another huge concern. This is crazy to me. I didn't even know that North Korea is going to shoot a missile and hit someone. Did y'all know that? I had no idea that was a real concern. Anyways, very, very interesting. Let's go into CME real quick. I want to show you guys the forecasting, what the market thinks is going to happen as far as interest rate cuts. More than likely, you guys, interest rates, once they start going down from the federal funds rate being cut, it's probably going to continue going down until there's a floor. So odds are when they do start cutting, they haven't cut yet, even though rates have dropped, they have not cut yet. It's likely that interest rates will continue to go down for a period of probably 2 years, I would say, depending on how quickly they have to do the rate cuts. If they have to do the rate cuts real fast because everything's falling apart, rates could be in the 4% in 1 year. It depends. The stronger the turmoil, the lower the rate. The less the turmoil, the higher the rate will be. Very easy to understand that. But take a look at the market, you guys. So the market is no longer saying that rates are going to be cut for obvious reasons in January. So they're saying, you know what? No cut in January. That's okay. Keep it where it's at. But take a look at March, you guys. So March is saying 73% chance of a rate cut. So the market still, even though we had the job numbers, inflation high, things like that, again, they're still saying it's going to start in March. In fact, 73% chance. Now, you guys know that I've been worried about that. I've been worrying about that because I've been saying, like, we don't want them to start the rate cuts in front of spring home buying season. So I think that that's going to hurt some metro areas if they do those little tiny cuts because of the mentality of people, because people spending habits. But again, it depends on the turmoil. People will not buy houses if there's a wave of unemployment. If there's turmoil in the economy, people will stop like we are, say, time out. Let's figure out what's going on. Let me make sure I'm safe. People aren't doing that right now. You guys are, but most people are not making sure they're safe, you guys. So anyways, I don't like it. I don't like that the rates overall are starting to be cut in March. Again, unless there's a whole massive meltdown. If there's a whole massive meltdown, by all means, let's chop those rates down. Because we will eventually be in an environment where prices of houses and interest rates drop at the same time. My God, though, hopefully that happens sooner rather than later. But take a look at May, you guys. Okay, so May, same with May. Okay, over 70% likelihood in a not the same rate cut, but a total of 50 basis point rate cut by May. So you got 25% chance of only the 25 basis point, but you have this whole big, likelihood that there's going to be a total of 50 basis point rate cut by May. Isn't that great, you guys? Is it, we're trying to smash inflation in the housing market, and they're going to start cutting rates right in the front of home buying season. So again, and we are in an election year. So I am slightly worried that they're going to be cutting rates too fast. But again, they're not going to cut rates significantly unless something super bad happens. And it's that super bad thing that we're really keeping our eyes on. But take a look at June. Same thing in June. Overwhelming, like almost over 80% chance and likelihood that total of 75 basis point rate cuts. Do y'all see this? I mean, it's absolutely bonkers, you guys. Okay, and you see here as well, look at this, another 25 basis points. So this was the last cut here, but look at this. This is rate cut on rate cut on rate cut that we're looking at. Not just like eventually we're going to have a quarter basis point. It's not that. It's like, okay, we're done with that rate cut. Here's the next one. We're done with that. Here's the next one. The market is saying that they're going to cut rates so same thing in September. You see it's at 400 to 425. Let's look at November. See 400, 425 is only 31. So they're basically, the market is saying a cut every meeting of 25 basis points for a total of 1, 2, 3, 4, 5, 6, 7. So the market's thinking 7. I want you guys to comment below. Let me show you one other thing. Let me show you what the suits are saying right here. So here's a nice little visualization as well. This is the rate cut forecast by institutions. So again, the market even though this doesn't show it, the market is mostly saying March, 70% likelihood of March, even though this doesn't say that. Look at, most people are saying June right now. Again, most people are saying June. So CME is off. So we can't trust CME, but regardless, these 5 companies, so we got 5 companies that are saying the rate cuts are going to start in March. You see this right here, Bank of America, Goldman Sachs, UBS, and then only one company is saying it's going to start in May, TD Securities. Lone wolf right there. Now, most people, and this would be good. This is what I've been cheering for literally for the last year. Like, let's make it to June. Please, for the love of God, please, can we make it to June? Most companies are saying the rate cuts are going to happen in June. Okay, we got Wells Fargo, HSBC is a big name, Barclays, Morgan Stanley, JP Chase, and then look at July, Oxford Economics and Citi. So most people are saying that the rate cuts are going to start in the second half of the year with 6 beginning and then 10 not. I don't know who to believe, you guys, because unfortunately, like I said, these things are always literally, they're just wrong all of the time. It's a little bit depressing, to be honest with you. So I'm going to get the next video queued up for us. And the next video is going to be, so the next video is kind of the opposite of the last two videos. The next video is going to be like, hey, you get the market's too premature on pricing and rate cuts. Like we don't have our economic turmoil. Like some people are like, why are you guys celebrating? You're cheering on losing your money. Yeah, the rates are going to go down, but they're leaving the if out. The if the market falls apart. If the market falls apart. How do you miss that, bulls? How do you miss that? And I know they think that they're just going to be bailed out, but here's our next video right here. I hope you guys enjoy.
Hotter than expected December CPI print. Our next guest thinks that Wall Street is currently pricing in too much easing and says now is the time to find some value in areas like small caps and biotech. Joining us this morning, BMO Wealth Management CIO Young-Yu Ma. Young-Yu, it's great to have you. Mester is on the tape a couple of moments ago, argues that March is probably too early. Sounds like you agree.
Yeah, it's great to be here, Carl. We do agree. We've actually been saying that for quite some time. We think that March is too early. And today's CPI print reinforces that. And we want to think about the Fed's dual mandate. The Fed's dual mandate is maximum employment and price stability. And we see from today's initial jobless claims that it continues to be the case that maximum employment is pretty much checked off. And really, the Fed has to focus on price stability. And there's not a lot of incentive to start easing rates prematurely when the Fed, at least in the back of its mind, is concerned that inflation could still creep up or we could get these spotty reports like we had last month. So we do think the summertime, probably the June meeting, makes more sense for the Fed to start cutting rates, and March is probably too early, and today reinforces that.
That said, you've been in the soft landing camp. You say they're still there. Talk about how that leads you to some areas like small cap value.
Well, small cap value, we think that's the intersection of what has lagged the market for probably more than a decade here. Both small caps and value have been big underperformers. And we just see a lot of value and low valuations and stable companies in that space. And we do expect the Fed to start lowering interest rates this year. And that'll ease some of the pressure off that space. And we think the valuations are attractive enough that it makes sense to start moving into there.
You also like biotech, and I am just curious for how long you've liked it, because it's been painful for people who have for the last few years and is finally showing some signs of life.
Yeah, we turned positive on biotech a few months ago. And really, it's a few things going on at once. In the sector, we have a lot of innovation, and we don't want to overlook the importance of that innovation. But this year, we also are going to have interest rate decreases. We think that'll help the overall sentiment in the sector. We think the M&A activity will pick up by year end. And overall, we think that the underperformance that biotech has seen over the last couple of years is probably going to be reversed here. But the backbone of that is innovation. And we think that investors are going to start focusing on that more this year.
You know, I think it was probably the middle of last year, people started coming to us arguing that Japan was a real story that was turning. Now we're looking at the Nikkei at 34-year highs. I mean, at what point do we start arguing that Japan equities have priced a lot of good stuff in?
Well, they priced some in, that's for sure. It's had a good 2023. We think the tailwinds for Japan are very long-lasting, multi-year tailwinds. Structural change is relatively rare, and when it happens, it's something that usually lasts for many years, or at least several years. And we think the focus on shareholder friendliness, corporate governance, return of capital, a better overall environment for shareholders, M&A activity, share buybacks, all of those things together in Japan really point to a longer-term trend that if these companies start returning capital, they make a lot of money. If they start returning more capital to shareholders, that will really be beneficial to equity holders in the market.
Really beneficial
Lots
to
of
equity
men have
holders
trouble
in the
performing their
market.
best in bed.
Interesting. Let me move on to the next thing. Man, you guys just all of a sudden had really good comments. So this is I'll answer the Q and do Q&A at the end. But It's not a difficult case. Economy isn't as bad as people want to believe. But, my first thought when I hear something like this is, then why did they make out $400 billion in bailouts in March of 2023? And why wouldn't the economy appear great if they printed trillions of dollars in the matter of 2 to 3 years and increased the money supply by 25%? Isn't it possible that that's all just a smokescreen? Isn't it possible that it's not natural? And isn't it possible that that was done because we were locked down? You remember we were locked down? Isn't that why the money was printed? Not because of growth, because of money printing. So again, I hear you. There's things in the economy that is really, really strong, or that appears to be really, really strong. And then there's also things that are very, very weak. So we have, to Adam's point, there are things that are basically strong, especially that because we have QT going on, but there's also things that are incredibly weak. And also the consumer is unraveling the trajectory. Okay. When you look at the trajectory of the defaults, I'm talking about defaults now, everything is skyrocketing. In fact, auto loans just beat the GFC. Okay, right now, FHA near the GFC as well. VA, GFC, 2009, VA, FHA, consumer credit cards, auto loans, everything except conventional mortgages. So I get it. I get these comments and I appreciate them as well. But that was the first thought, Adam, that came to mind is if it was strong, then, why the money printing? Why do they have to bail out the banks? What would have happened? Ask yourself, Adam, what would have happened if they didn't bail out the banks? What would have happened? I think I know what would happen. Granted, hindsight is 2020, right? We don't know what would have happened because they did it. So it's impossible to know that for sure. But I'm going to tell you what would have happened. Something really bad would have happened. And we had bank runs. We had the second, third, and fourth largest bank failures in the history of the United States. And our economy is great. I'm looking through the cracks. There are some great things. So I'm definitely not knocking him at all. So I want to show you guys this next thing. Let's go into the trip. I want to show you guys kind of where I'm going. And then I want to talk about the home buying course real quick. I really appreciate everyone's comments. Now, here's what I'm doing, you guys. So I wanted to let you guys know I am leaving today again. Okay. I'm leaving today. After this live, I'm going to prepare to do a collaboration with Danielle DiMartino Booth. So after that collaboration, you guys, I am out of here. I am leaving for about 2.5 weeks. I'm going to miss you guys terribly. I'm going to miss my family even more. I'm already depressed about not seeing my wife and children. But I'm leaving today about 1 o'clock through the blizzard that's happening on the East Coast right now. So I will be driving through that. I'm super nervous about that. Say some prayers for me, you guys, because I hate driving in ice. It's super scary. I don't have the experience, but let me show you where I'm going. All right. Now, remember, you guys, I'm using New Home Source. Okay. And when I get to these areas, I'm going to show you guys that the inventory is unreported. I'm going to show you when we're there. And I'm going to do this with Melody Wright. Melody Wright and I are going to tour for about 2 weeks the East Coast. And so with her insights guide and her perspective with my video creating and boots on the ground, I think you guys are going to get some really sick videos. I think the video content for the next, probably month is going to be probably some of my best videos I've ever put out. But this is something that I use, you guys. So the first place we're going, you can see here is Huntsville. And you see all the new home building? So we'll be going to areas that are north and maybe one area that's east. And then we'll be going to some of these subdivisions. So usually about 6 subdivisions of metro is what I'm going to try to do. But you guys, I'm going to be going, this is how this is going to start. And then I want to show you the home buying course real quick. Okay. So, and by the way, you guys, we have almost 1,000 people who signed up for the free home buying course. And guess how many people I've emailed? No one. The course is for you. I don't want your email. If you feel uncomfortable putting your email, fake your email. I don't care. I'm not going to reach out to you. I wanted you guys to know at least one person with expertise in real estate that did something for you for free. And I'll take care of myself eventually. But I said, before I sell anything, before I do paid classes, any of that, I'm helping the people that want to be helped that are at the bottom because those people don't get enough help. So I've made this class for you guys. It's a great class. We have, I think, 936 people. I just wanted to show you guys, but back to the trip. I'm sorry, I'm all over the place, but we're going to Atlanta and then Charlotte, Raleigh, Richmond, Washington, D.C., Wilmington, Charleston, Myrtle Beach, and Huntsville, possibly Delaware, and possibly in the Knoxville area. So I can see Trey because I love Trey. All right, take a look. This is my home buying course, you guys. All right, if you're not taking this, you're missing out. I put my heart and soul into this. It's free. But I wanted to show you guys again. Basically, there's 2 chapters I've made so far. First one's purchasing power. We go over credit, income, assets, and mortgage. Second one is creating homeownership goals and understanding them. So I have the intro. I have basically breakdown on payment, price, how to have an investor mindset, what wedge basics are, cash flow basics, what to ask a seller for, and then a recap. I mean, this stuff is golden, you guys. Let me just click on, let's go income real quick. So this is what it looks like. I have my little video here, right? And I actually have 2 videos on this summary. And then I have a budget tracking. Mint.com is no longer in business. It has a lesson summary. It has a quiz for you to take, which, by the way, grades are not recorded. There's some errors here. The thing is, guys, is I don't have it recorded because it costs me more money. I'm paying $65 a month. If I do and I want to eventually get there, maybe if I end up selling courses, I'll pay for it. But it's about, I think, $165 just to have recorded grades. And it's hard for me to justify that because it's costing me money. But anyways, guys, I wanted you to come here. Really great course. Obviously, I have 2 more chapters right here, which is understanding local market trends and finding the right professional. So I don't know. I plan on doing everything for free. We'll see what happens, but I just want to give you guys an update on that. Let's get back here now and let's take a look at some of these questions. The course is in my video's description, just not my live videos. So if you go to any video that's like an edited video, Metro video, whatever it is, if you go to the description, every video will have the link to the free home buying course, and we'll also have a link to the Discord. And I've been getting some emails, guys. And some of these emails I get that's asking me for my opinion and advice, it's very heavily complicated. And I haven't been able to get to it. But, Discord is a place where you can get perspective, not just from me, because I'm really busy. I can't always do it, but also from the community of Real Estate Mindset. So there's a lot of people that are very, very smart. All right. So a couple things here, guys, I wanted to highlight. This is a good point from WTH. I mean, if your credit is not over 700, right now, especially, you should probably not buy a house. All right. But also that's not fair because when I bought my first house in Texas, my credit score was I think 620 or 630. And I only had a 3.5% down payment and I made a ton of money off the house. So every situation is different, but I was responsible. That's the hard part. Not everyone has the same level of responsibility. And then boom. So I'm going to be doing a separate video on some of this stuff. Here's a comment from Mr. Watson. Employment is still red hot, though. I think the reversal of the inversion is expected for the Fed to lower rates this year, not necessarily recession, but I don't know. So the thing is when we compare the job market to the GFC, the job market's hot because people could still get a job. But when we look at the actual numbers, the job market's not red hot. The job market, in my opinion, but again, when we compare to the GFC, yeah, and when we look at only the unemployment rate of 3.7, that is so low. So I'll agree with Mr. Watson. If there's still jobs and people can still get paid, things are going to be propped up for a bit longer. But to ignore the 1.5 million, again, 1.5 million full-time jobs that were lost in December, you can't do that. That's recessionary. That's only happens during recessions and economic turmoil. But I mean, there's still jobs. But a lot of that is tainted, I think, government jobs, seasonal job, part-times, dual workers. So it's not like they're real good jobs. But, again, when I look back at the GFC, I couldn't even get a job. So, I mean, he has from that angle, I understand. Okay, this is true. Wells Fargo did stop doing mortgage. They are doing them for their customers. That is huge, you guys. Just to let you guys know, there is a lot of turmoil going on in the mortgage industry. The company I stepped down for is going out of business. That is a huge shocker. They were in business for a long time. Boom, boom, boom. Keeping a balance. Yeah, and see, great point here, man. And I'm just flashing these because, again, I'll make another video. But you don't want to have a balance on your credit card. If you have a balance on your credit card, you probably shouldn't buy a house, and that's just the facts. Probably, right? I want people to have the dream of home ownership. Now, the reason I'm bringing this comment up is because I forgot to mention this earlier when I was going over mortgage interest rates. He's basically, House Hacker is saying Wells Fargo is trash his current lender on the first house. So the advantage of using the big 3 is interest rate. Okay, and let me tell you guys about interest rates. First of all, not taking the depository institutions like Chase, Wells Fargo, and B of A. The difference is this. You have a broker and you have direct lenders, okay? Generally, and I know this because I just had a customer that I was talking to shop 2 mortgage lenders. Generally, when it comes to a broker, you're going to have a lower interest rate. And I'm not talking about a little bit, a lot lower interest rate. But generally, you're going to get worse service. Generally, when it comes to direct lenders, because they have more money to put into staff and technologies, you're going to get generally, you're going to get a better service. but your interest rate's going to be higher because they build in the cost of doing business into the interest rate. So they're like, well, we'll give you this technology, we'll offer you great service, but we're going to charge you for it, and we're going to charge you for that in the interest rate. So the difference could be 3/4 of an interest rate. But likewise, Wells Fargo is a direct lender. And so these massive direct lenders like Wells Fargo, again, Chase and B of A, they can usually offer rates close to what brokers offer. But I will argue, like House Hacker is saying here, their service is complete trash. I mean, their service, like the big three, is worse than the brokers. And the brokers have the worst service. It's just the people that are working at Wells Fargo, you guys, they don't know anything. They just have someone's getting paid hourly and they're like, oh yeah, I'm a loan officer or whatever. But when it comes to challenges, they're absolute trash. So I wouldn't even think about going to Wells Fargo or in the big three unless I had phenomenal credit, you guys. Phenomenal. Yeah, and this is a great point. Strong economies don't lose, thousands and thousands of full-time jobs. Okay, living in Omaha. So not in my area. So he's saying that new construction, the cost to develop raw ground and lots keeps going up. In his market, I keep forgetting what market's yours. Because there's no easy ground. See, I'm in Texas living in Omaha, so we don't have that. But San Diego, Anaheim, they have that. They have a lot of restrictions, but here we don't have that. I mean, we got land, literally, I was looking at land 2 nights ago. We got land everywhere. So, and that's another thing. The builders can afford to go down lower on prices. They can afford to do that and still build because their profits are so high. So this real quick, again, I'll make a separate video. A lot of good comments. There's already major corrections in commercial real estate. And as far as residential, and there's already major corrections in new home construction. But as far as existing, we don't have major corrections on a nationwide average right now. We have, again, a handful of metro areas like Austin that is falling apart and has been falling apart for a substantial amount of time, as well as places in Texas as well. A lot of comments from House Hacker. So here's the thing. Every time the rate drops, it creates affordability to some people, which means demand will increase. The thing is it really doesn't, House Hacker. Like a quarter basis point drop is like $50 a month. So it's a mentality thing. I think what's stronger than what you're saying, because again, it's a quarter basis point. It does nothing. It does nothing for you. It's the mentality. But again, we also know, and the other part of the coin though is we know that the federal funds rate doesn't track mortgage rates. So mortgage rates went down without them even cutting the federal funds rate. So it depends. If it's only a quarter basis point drop, yes. But what we've had is more than a quarter basis point drop on mortgage rates. We've had over, 130 basis point drop. So yes, 130 basis point drop to go to his point on mortgage rates, that's pretty substantial. That does free up some buying because that will lower payments by probably close to $200. Close. But then you ask yourself, if $200 was setting you apart from purchasing a house, can you really afford a house if you're saving $200? Can you really? Right? If that's what it was, right? If you're now qualified. Luke, just email me, put Texas info if you want to talk. All right. So here we go. The biggest component increase in shelter costs was insurance, not home prices. But see, the thing is, Dad, is why did insurance go up? Insurance went up because the assessed values of houses went up, and it's lagging. So we have actually 2 things going on with insurance. First of all, you have California and you have Florida, where they have an overwhelming amount of natural disasters. So that alone is going to increase insurance. But what is hitting every single person is as a result of home prices going up. So as a result of home prices going up, get it? As a result of the home prices going up, it now costs more money to insure houses for insurance companies. So 3 years ago, maybe there's a $200,000 house. You only need $200,000 in insurance. But 3 years later, that $200,000 house is now a $350,000 house. So now you have to insure a $350,000 house and not a $200,000 house. And that lags. And that's why you see property tax exploding and homeowners insurance exploding, even though prices are on average pretty much sideways. Because again, home prices increase. Same with property tax. Property tax is called assessed value. All right, let's see here. I feel bad for first-time home buyers as well. I get it. Houses are overpriced, unfortunately, the longer they... And see, this is the thing, House Hacker. This is why I'm so convinced that prices are going to come down. It's like a slam dunk to me because I've seen it go down at numerous times when the locals cannot afford to buy houses. It all comes crashing down. What's happening though is, again, we still have excess money and we still have mad migration into some areas. But like, if the locals can't afford to buy a house, you're screwed. Except in maybe places that are super dense. Again, I go back to where you're at, San Diego. There's like no inventory. So San Diego is going to be an area where I think it's going to go down as a result of economic turmoil. But I think other areas, we're not necessarily going to need the economic turmoil because it's so out of reach already. And again, Texas. Watch Texas. Texas is going to be the leading state. We already see that right now. But, you know, very, very interesting things. You guys are just a wonderful bunch of people. I really appreciate you. Okay, so let's say it real quick. Okay, so last question here is if property values drop, will property taxes also decrease? The answer is not right away. And that's why I'm saying, like, you're going to see the reverse. And that's why you see insurance going up, property taxes going up, because it lags. So, like, if property values keep going down, it's probably going to be a year, maybe a year and a half for the county to go reassess the value of the house and then thus dropping your insurance. I'm sorry, not only just your insurance, but your property taxes. So two things will happen. If prices go down, which on average we're saying, they're already going down, and I'm talking existing. They're already going down in new homes. That's a fact. But for existing, it's going to take some time because it all lags. But yes, not right away, but yes, it will eventually lower your property taxes and also your homeowner's insurance. Great stuff, you guys. Really appreciate everyone. Once again, shout out to everyone. Adam, appreciate you being here. D-Day. Comic Lovers in the house. Appreciate you, Comic Lover. Baller house by that man. Appreciate you. Everyone, appreciate this. Don't move. Appreciate you participating today. Really, really just I'm overwhelmed with love, you guys. I really feel like I'm doing something good here. I really feel like I have a purpose. I feel like I'm a voice of reason, a voice of light. You guys help me with that. Again, I'm so humbled. I don't even know why you guys listen to me, but I will continue to be transparent, share with you my thoughts. I know I'm bearish, but you know what? Do you really want someone to be bullish when it comes to your money? And we have such economic uncertainty. I want to be bullish, you guys. I want to. I love real estate. I've been in real estate for 20 years. I make way more money when real estate's doing well. But again, I got burned during the GFC, and right now I turned into a hyper bear. You're going to get a hyper bear. You're going to get someone that really cares about your money. And also, y'all, I'm giving you the links. I'm sharing my perspective. I'm staying in this chair no matter what happens. And I'm doing that for you guys. So thank you. I really appreciate you guys giving me a platform to educate and to empower. And that's exactly what I see myself doing. So thank you guys so much. I'm going to get out of here. Thank you again for your recommendations on the course. I mean, I put up my heart into that course. And you guys, don't forget, say your prayers. I'm going to be on the icy roads for quite some time. I'm leaving at about 2 or 3 o'clock. So I'm really excited about that. And other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win. And also, stay warm.